Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Brent Schutte of Northwestern Mutual Wealth Management joining us now. Brent, what's your first reaction to the CPI print? How much does it color how you see investing next year and the backdrop for the Fed?
I think it certainly helps the parts of the market that you mentioned before, small caps that have been harmed by higher rates. And so if you think about the economy the past few years, it has certainly been bifurcated, as has the market. It's been narrow, both in the economy and the markets, where you've had the heavy lifting done by a few stocks tied to higher income consumers and the AI theme. And I think as you look at 2026, we do see broadening, where you see small caps doing better, where you see the average S&P stock doing better. I think it's a risk management tool, but it's also in 2026 a return enhancement tool. And so that's my first thought. My second thought is what's happening underneath in the economy when you see inflation pull back this much. How weak is actually demand? And you mentioned the labor market, which I think people are giving coast-all clear because of non-farm payrolls being around 60,000, which I remind you, they were overstated by 70,000 in the data going through to March of this year. And the Federal Reserve Chair Powell mentioned he still thinks they're being overstated by 60K. So they are right around zero. And that's where I think there's some risks still that are out there.
Do you think that the market response, that if this gives the Fed the green light to cut rates, then that's positive for equities, is correct? Or do you think that it's coming more from the labor market weakness that you were just referencing?
I think it's positive for a broader set of equities. And that's where I think I come back to no one knows exactly what's going to happen in the next 6 months. I think forecasting is always difficult, but there certainly is this odd kind of mix of policy that is out there. And I think you can see that through the Federal Reserve eyes, where if you had all 19 voters voting, it would have been 12-7. And you see those dissents. And that's where I just think it's hard to figure out what's going on in the near term. But if I think about the long term, I do want to pay attention to valuation. And that's where I go back to those areas of the market that people have largely ignored. They haven't done as well because of the impact of higher rates. I think pushing forward in 2026, you have valuation with you, and you have potentially the impact of rising earnings in those parts of the market for the first time in a few years.
Brent, let's have some fun here with counterfactuals. You've opened the door, so I'm going to drive my truck right through it. I'm very curious, if we'd gotten these data before the last Fed meeting, how that conversation in the Eccles building would have been different, if at all. I mean, we talked a lot about this being an insurance cut. There was certainly a lot of questions about whether the Fed should move that or wait till January. Do the data that we've got today give you any sense that it would have the outcome would have been different last week had Fed officials gotten them?
Potentially, but I don't think people's concerns about inflation longer term are going away. This could be certainly tied to the government shutdown with inflation coming down. It could certainly be tied to the labor market weakening. Look, I think inflation is a longer term phenomenon. We have not yet returned to 2%. The Fed's dot plot doesn't show it returning until 2028, which is 7 years since. And this is where I think there's concerns about what happens next year when the stimulus gets layered on, what happens next year when we get a new Federal Reserve chairman, and what happens longer term to help pay back some of that debt. And that's just where I think inflation probably still is the longer term outcome. And that's where I think the concern of some of those people on the Federal Reserve would not have gone away. Perhaps you would have swayed one or two more people. But I think there are still legitimate concerns and questions about, do we get back to 2% inflation absent some sort of economic contraction in 2026, which no one is pricing in right now.
Brent, the overlay here, of course, is this AI story. We've been tracking that day in and day out, all the ups and downs. Certainly, Micron, the latest kind of chapter in that narrative. We heard policymakers engaging more with this issue of productivity, what this is going to mean for the economy or could mean for the economy going forward. How are you thinking about that in light of what you're talking about here, the kind of the persistence of inflation into 2026, the challenges facing this U.S. economy going forward?
I mean, we'll see on the productivity aspect of it. I think companies are still trying to figure out how to use it to increase employees' productivity. And I think that's a prime question as you head into 2026. I think the reality is you are starting to see it move through different parts of the economy. So it started out in the picks and shovels, I guess, and now it's moving along to companies like Micron. I eventually assume it will do much like the internet did, which is increase the productivity and efficiency of all companies who actually use it. And so that's where I think you're seeing winners and losers change. I think you will continue to see that in the future. And that's where I think anyone investing solely in AI right now or concentrating their portfolio in it is taking risks they don't need to be taking, because I think there are opportunities as it continues to shift, as it continues to spread through the economy for those companies and stocks that have previously been left out to start benefiting from it. And that's where you saw this broadening in 2000 through 2007 that occurred post kind of the concentration in 1998, 1999, which is eerily similar to today, where a few stocks did the heavy lifting for a few years. People concentrated in those, unfortunately, and then the game changed going forward, which I think is what's going to happen as you push forward into 2026 and beyond.
Stay with us. More Bloomberg surveillance coming up after this.
Erika Najarian of UBS writing, banks might be more motivated to close larger deals ahead of any potential shift in power in Congress. The first half of 2026 could be a robust time for deal announcements. Erika, I'm so pleased to say, joins us now. Erika, great to see you.
Good to see you.
I'm not saying that OpenAI and Veda are going to merge, but there is this feeling that there is an acceleration in the deal space. Just how much pipeline is there behind that?
I think bankers are not going to have a fun Christmas season. I think they're going to be at their desk working, because I think 2026 is going to be the year of big. I cover banks, so whenever we talk about M&A, we think about regional banks merging for synergies. But given the deregulatory framework, and given that you do have the midterms as sort of an important waypoint in time, I think you could have banks and other companies across the space really thinking about where their strategic holes are and addressing it that way. So I think it's going to be more than just, okay, we're going to do deals to cut costs. I think they're going to use this as sort of a, once in a generation opportunity to redeploy capital in a very specific strategic way.
Because a lot of the deals we've seen have been really big. I mean, whether it be in IPOs, the Medline IPO coming on the market earlier this year with EA, the huge amount of numbers that are being put to that, whatever is going to happen with Warner Brothers Discovery, maybe we add that in, that whole hot mess of a potato in with that too. How much of this and the resurgence of deals are about big size deals versus volume of deals?
I think you could get both, right? So first of all, the sponsors haven't really, exited much, so we're waiting for that. The market is at all-time highs, spreads are at all-time tights, so it feels like now is the time. And I was here last week when I had this analogy that this administration was going to put lipstick and contour on this economy to get it through the finish line for to the November midterms, right? And so you could have sort of also a macro backdrop, and maybe we get 1 or 2 rate cuts that's quite favorable for this environment.
By the way, can I just say we should only start using makeup metaphors and no more baseball metaphors. No more innings, only lipstick and contour. I'm absolutely on board with that, Erika. How much of this, though, when it comes to strategics versus private capital, because to your point, they're still sitting on a lot that they need to exit. Are they willing to take a discount, or has the environment gotten so good that things that they maybe overspent on in 2021 and 2022, they can sell at a price that they agree to?
I think you still have a pretty significant valuation disparity. And I think you also have, your deployment of capital is not going to be as, those investments are not necessarily going to be as good as those that you're trying to exit, right? So I think that's going to be, continue to be a challenge. But nevertheless, I think in particular with I think the advisory pipeline is going to be is actually quite strong, and you had the government shutdown, so the fourth quarter is going to look a little bit light. So that's going to have the effect of pushing a lot of these announcements into the first quarter, and so you're every sort of Sunday evening or Monday morning is going to be boom, boom, boom in terms of announcements. I think when we kickstart the year.
Talk to me a little bit more about the financial M&A.
Yeah.
On the strategic side, what are the strategic priorities of an M&A for banks at this point if it's going to happen in the first half of next year?
So scale and completeness, in my opinion. and additionally, an edge in tech. So, for example, it's pretty clear that scale is getting to be even more important given the technological demands, the investments that are needed in AI and the like, right? So that's number one. Number two, you work at a company that's very diverse, for example, right? And so the whole idea of a booming money center, complete money center bank, I think is, highly subscribed by the market. So let's say you're an investment bank, maybe you're seeking more of a wealth aspect, or Wells Fargo has mentioned potentially expanding in growth areas if it were appropriate. So these are sort of the strategic points that I think are going to be addressed in the new year.
A lot of people are very excited about financials at the same time that they're very concerned about some sort of glut in private credit, some sort of excess that could potentially come to roost in 2026. Is there a dissonance in this, the idea that people think that there is no credit risk in banks, but there is full credit risk in private credit?
You can't have an explosion without getting shrapnel, right? So I would say a couple of things. Number one, everybody is hyped about bank stocks, but bank stocks rarely outperform the S&P 2 years in a row, right? And when it's happened on the back of a recovery cycle, right? Think post GFC or post the dot-com bubble, right? So the bar is high. Second, we have to watch the sector rather than just say, okay, there's something, out there that we have to be nervous about. What do I mean? Is there froth in data centers? Is there froth in, other so it's really a sector issue rather than structure. So really, it's going to be, right. What the banks have done is they've indirectly lent to financial institutions that then lent to the companies, right? And we saw in the matter of the First Brands, for example, that when you have, an explosion, obviously there's fraud, the banks will catch some shrapnel. So we'll see.
Well, Tom, to this point, I mean, how much are people understating some of the credit risks here, given the concerns about the likes of Tricolor or First Brands?
I think what Erika's trying to drive out here, too, is the important piece of this. It can't be just private credit's the issue and not the banks. I mean, let's just acknowledge that up front. But as you're moving through this froth, I think the way you made the comment about the fraud is, when we look back in history, guys, fraud is a bankruptcy. It's not it's fraud, that gets an asterisk. Like, if we have these types of problems that are going to surface, I do think the banks will get tied down to that. So maybe, Erika, last question. As you separate these, which banks are best positioned into 2026 if we were to hit a default cycle? Just the well-diversified banks, or is there something to that, or an angle that you focus on? And
by the way, it's not a coincidence that Tricolor and First Brands were in the same sector, right? So this goes back to what I was saying. It has to be a sector. Look, I really like Bank of America here. Right? So all the things that, perhaps was a negative for Bank of America, to directly answer your question, not growing as fast as others, being a little bit more conservative in an environment where, there's a little bit more uncertainty and maybe we are just band-aiding the economy. I think they, could potentially perform well, and the valuation is, not all that demanding. A company like, Capital One, that lower end of the K has taken hits already, right? I mean, we've talked a lot about the K-shaped economy, but who's been dealing with inflation since 2021? It's been the lower end of the K. So I think that, those two stocks set up really well for 26.
Stay with us. More Bloomberg surveillance coming up after this.
Joining us now, Henrietta Treyz, Director of Economic Policy Research at Veda Partners. Henrietta, what was your take from the announcement, the speech last night?
Well, it definitely wasn't about the Christmas decorations. 90% of Americans, according to the latest Fox poll, believe that inflation is the biggest problem facing them. And what's a little bit off-putting is that the president touted a lot of data sets that just are not resonating with American voters or factually accurate. So anybody who's turned on the news this year has seen AI and data centers driving electricity prices up 13% for residential electricity prices nationwide on average. If you tell me that the cost of drugs is dropping by 400%, 500%, 600%, which is what the president said last night, that means you're paying me to take drugs. And you don't have to be that good at math to know that that's not how drugs work. And finally, I would say the $18 trillion investment that he touted from the trade wars that he's launched and the deals that he's reached is outrageous. I mean, this is like China's entire GDP. You need to put some things in context that American voters can actually take with them to the grocery store, and that's not what we got last night.
Henrietta, just that point, I mentioned this before, that Scott Linsacombe of Cato Institute was talking about the fact that this is the 10th thing that Trump has promised to fund with tariffs. I'm going to be honest, ChatGPT helped me with this list, but I was just looking at some of the things that were promised: the military checks, tariff dividend, farm aid and targeted bailouts, child care, social programs, tax cuts or elimination of income tax, foreign or industrial subsidy funds. Henrietta, I know a lot of those are a wish list, to Lisa's point, versus actual policy. But what happens if he does try to fund some of these with the tariff income? Is that even possible with the amount of money coming in?
I mean, first off, find me the votes. If you can find me 51 votes in the United States Senate for a $450 billion, $2,000 check to the American public, I would love to see it. I can't count you the votes. I can't get you a reconciliation bill. I can't even get you a budget for fiscal year 2026. So the idea of even getting these things through is not realistic. And then the bond market, of course, is counting on this, what CBO estimates is $3 trillion in revenue brought in by these tariffs over a decade. And we've already spent it. We've more than spent it. It's only been $89 billion brought in by the IEEPA tariffs going back to October. So, I mean, the money's just not there, and the votes aren't there either.
Henrietta, it's a great point. I also want to get back to one of the other things you just mentioned, too, this idea of the consumer feeling also the affordability pain of what's happening with their electricity prices. We saw the Blue Owl and Oracle deal. Part of the reason it crumbled was because of the politics in Michigan of lawmakers pushing back against tax subsidies. Earlier in the week, we also heard from Bernie Sanders saying that there needs to be a moratorium on building on data centers, partially because of what you're describing with the prices. Is it likely, as affordability becomes a bigger issue, that lawmakers will really start to push back against some of the data center construction and spending that is happening in America?
Yeah, you can see it all over the place in terms of physical pushback. AOC had some tweets about it yesterday. I saw it's definitely a popular talking point. There's not going to be any legislation to prevent it. So this would have to be active, boots on the ground, district led, sort of protests against the construction of new data centers. And they're going to have to conflict that with the, job creation, which in many of these cases is the only job creation that you're seeing in, say, the manufacturing sector. So it's a pretty heavy lift to get something done legislatively. And then certainly to have the protests be maintained in order to actually effectuate those pauses or stoppages.
Stay with us. More Bloomberg surveillance coming up after this.
Pooja Kumra, European and UK rates senior strategist with Securities, joining us now for more. Pooja, what's your take on this, given the fact they did cut rates as widely expected, but what you did see was that fissure increasingly on the committee?
Yeah, no, exactly. It's surprising that the committee is still very divided, as seen from the vote, as well as when it comes to the guidance. They have not given a clear path with respect to the pace of cuts, or we know that BOE is in the upper end of the neutral, which is basically 2 to 3.75. But the guidance around how much below they want to go towards the neutral is really lacking. And I think that has come as a disappointment to markets after yesterday's weak CPI print. And that's why you are seeing gilts actually selling off. Even on the budget side, they consider it to add a point or two on growth. On inflation, they are still seeing medium-term inflation to increase by 0.1 to 0.2. So I think overall, the messaging is very mixed. Even if you look at Andrew Bailey's comments here, They are looking at the downward trend on labor market, but they still don't want to overread into it. And same with inflation. They don't want to overreact into the numbers that we've seen last time. So overall, I would just say that the mixed messaging is something that's not changed. Markets were still worried about the pace of easing by the BOE. Markets were pricing around the next cut around April. And the current messaging does not really change that situation. There's just no pace or what type of momentum in terms of cuts we'll see from BOE. And it's not been consistent as in the case of Fed or in terms of ECB. But I think it's the data that will be speaking. And if we do see that inflation and labor market easing, the next cut should be by Q1 in our view.
And just to the point of the division, Pooja, and the not clear outlook, part of the statement was that judgments on further easing will become a closer call. How much room is there to cut at this moment if the data stays similar to how it is now, Pooja?
So markets-wise, again, there is not much room within. They're just looking for another cut from the BOE, and the timing was around May, and I don't think that changes right now. To us, again, we also think that BOE definitely has room for one more cut. They will be still in the restrictive stance. If you see, the neutral range for them is, as I said, is around 2 to 3.75. So they're actually in the upper end of the neutral. So there is a lot of room to ease, but the evidence in terms of labor market and inflation has been very slow moving in UK, and that's why they want to keep the easing path slower than what should be the case. So we and markets are particularly looking for just one more cut, but I think the risks are for more cuts when it comes to UK.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.